Stocks only go up like AMC and GameStop. Whenever you hear the government or the Federal Reserve is printing money, you probably think, okay, stocks are about to skyrocket. It does make sense. More dollars floating around means more cash chasing stocks. But here's the truth. Most people miss printing money doesn't guarantee the stock market will rise. In fact, sometimes it's the complete opposite. And today, we're going to be breaking down exactly why. Because if you understand this, you won't fall for the hype next time you see the money printer going burr. Okay, so let's start with a common belief. The idea goes like this. More money in the system means more liquidity. More liquidity means more investors have extra cash on hand. Extra cash flows into stocks, which pushes prices higher. Simple, clean, logical. And yes, it sometimes does happen. That's why after the 2020 money printing, we saw a massive bull run. But here's the catch. It doesn't always work that way. And believing it's guaranteed, it's how investors get burned. Here's the thing. Inflation will eat your returns. When you flood the system with money, prices rise. And if companies can't raise their prices fast enough, profits are going to be shrinking. So yes, there's more money out there, but it buys you less. When it comes to grocery prices, let's look at the CPI versus the earnings. Interest rates are going to be killing the rally. When inflation rises, the Fed usually raises up interest rates to cool off things. Higher rates make bonds, saving accounts, and even cash look more attractive than stocks. That pulls money out of equities. Stocks are ultimately priced based on how much money a company can earn in the future. If people aren't buying products, if demand is weak, no amount of money printing will save those earnings. Investors aren't robots. If people are scared like in a recession, they may hoard cash or put money into gold and treasuries instead of stocks. Liquidity is there, but no one wants to use it for risk. And going back to human psychology, let's take a look at history. Japan in the 1990s, the Bank of Japan unleashed huge amounts of money printing, but their stock market stayed flat or worse for decades. And why, you ask? Why did it stay flat for decades? Their money was stagnant, demand was weak, and companies weren't growing. Let's go back to 2008, the financial crisis. The Fed printed a ton of money to stabilize the banks, but stock prices didn't immediately soar. Why? Because most of the money stayed locked inside the banking system. The average person and small businesses didn't see it, so demand stayed the same. And here comes the COVID pandemic. Now compare that with 2020. Not only did the Fed printed a lot of money into the economy, but the government also sent stimulus checks directly to people and businesses. Suddenly, demand rebounded, companies made a lot of money, and stocks were skyrocketing and making newer highs. So you see, it's not about the money printing, it's about where the money actually ends up going and whether it turns into real demand or not. So if money printing alone isn't the magic key, why do stocks move? Stocks moving and making higher highs are dependent upon corporate earnings, dependent upon their growth, innovation, productivity, and the investor confidence that they have in the company. Global trade and capital flows do also matter when it comes to stocks making newer highs. Printing money is like fuel. It can make the car go faster, but if the engine is already broken, meaning weaker demand, low earnings, or scared investors, the car won't move. And you understand that. And when it comes to money being printed into the economy and your stocks going high or low, what does it mean for you? Don't assume the market is on autopilot. Whenever you hear about money printing, look deeper. Are companies actually earning more, or is it just inflation? Where is the money really going? To the banks, to the business, or directly to the people? As an investor, you should be doing your own due diligence. Your best move is to stay diversified. Watch the fundamentals, not just the headlines, and don't chase hype stocks, because if it were that simple as printing dollars to get rich, we'd all be billionaires by now. To wrap things up, printing money adds fuel, but it doesn't steer the car. The real drivers of stock prices are corporate profits, global demand, investor confidence. Printing alone doesn't guarantee that stocks will go up, as we can see. As soon as the government printed money into the economy in 2020, we saw stocks making higher highs. But guess what? Now, here comes 2025, and we all feel like we are about to end up in another stock market crash, and we're actually in a bubble. So the next time you see the Fed pump trillions into the system, don't assume the market will fly. Ask yourself this question: where is the money going? Who is actually benefiting from that money? So if you found this video helpful, make sure you subscribe to the channel, hit the like button, and leave a comment down below. We are a small channel, so I would really appreciate it if you guys hit that subscribe button and show your support. I do have links down in the description at the bottom, so if you want to start investing and want to be financially stable and wealthy, go ahead and click the link down in the description, and I will see you in the next one.